Hi everyone, it's Marvin at Mortgage Choice. How are you? It's Wednesday, the 3rd of June, and there's an awful lot happening, as you can imagine. So I'm going to try and condense it into 3 or 4 minutes, and we'll see how we go. So hang on to your hats. The first one is news this morning. We had a negative quarter of growth in the March quarter, so growth was negative 0.3%, and given that we all know what we were doing in April, May and June, which is basically not a lot and not a lot of spending, it's almost certain we're going to hit a recession. Now, recession is just a technical definition, and it means 2 quarters of negative growth. What's probably more important is, because there's no surprise there that was going to happen, it's more about how we come out the other end. And increasingly, the data suggests that we're coming out of it faster and better than had been anticipated. Banks are releasing some data around debit and credit expenditure, and it's lifting, and it's actually higher than it was this time last year. They're also reporting fewer cases of hardship, and they're also beginning to report an increasing number of people choosing to jump back onto making regular repayments on their home loans. So at a macro level, it kind of feels that things aren't as bad as they could have been. Now, that's not to say that at an individual level there's situations of distress and stress, and I've dealt with a number of those calls, but at a macro level things are looking better. And I guess the key proviso there is we do not have a second wave, or if we do, it doesn't shut things down again. Okay. Yesterday, the RBA announced no change to their cash rate, and they've actually said that they don't expect to change it for some years to come. We are in low interest rate territory for best part of a decade. They want to stress that there's only so much they can do, and now they need fiscal stimulus. And what that means is government spending money. And the federal government has clearly signposted they're about to introduce some sort of grant to support new buildings or even renovations of existing buildings. And it's all about to ensure that the construction industry stays employed, because some of the numbers in terms of their forward orders aren't great, like down 40%, etc. So with an unemployment number that is already going to be nudging closer to the 10% mark in the near future, once JobKeeper stops, they're very nervous about particularly that industry, and that's why we are going to receive some sort of incentive to build or even rebuild. Other news is stamp duty. Stamp duty is really expensive, and it feels really unfair, and it penalises those people that maybe for their job they have to move every few years, and they're having to pay stamp duty every time. So it looks like that's going to be replaced by a land tax that will pay on an annual basis and effectively replace stamp duty over time. Now, that will reduce the purchase cost for buyers, but I wonder if that'll feed through to prices, because vendors now know you've got an extra 30 or 40,000 to spend on the price of a property, rather than spending it on stamp duty. We'll see, but clearly there's now momentum to make that tax fairer. Other things, property prices. There was some doomsday stuff around property prices dropping 20 to 30%. Unless there's a second wave, that, in my view, is unlikely to happen. I reckon 5 to 10%, and we may have seen much of that already. And I think it's all about the supply-demand equilibrium. And all that's happened is that whilst there's fewer buyers, there's also fewer sellers. So it's keeping a flow in the market. So I think the more interesting stat will be to keep an eye on the volume of transactions that are going through, and that'll give us a general sense of the appetite and the health of the property market. But we're certainly not seeing the types of price drops that the more sensationalist reports were suggesting some time ago. It's nearly the 30th of June, it's nearly tax time. Here, focus on your deductions, try and find them. Legitimate deductions of course, in case the ATO is watching. So things like donations, things like voluntary contributions to your super, and also obviously depreciation if you've got an investment property. And remember that the ATO have introduced simpler method of calculating deductions if you've been working from home, although you must keep a track of the hours you've spent at home working. And then the last thing is to catch my breath, refinancing. There are some super sharp rates out there, particularly around fixed rates. So I know one of the key lenders, CBA, have reported that the demand for fixed rates has doubled in the last couple of weeks, and we've seen that as well. So we've been saving clients a heap of money, both on variable and also taking the opportunity of fixing their rates. And that will continue, I reckon, through the rest of this year and into early next year. So if you haven't looked at your home loan for a while, you're leaving money on the table. So give us a call. Right, I'm going to go lie down. Have a great rest of June. I'm here. We're all working, most of us from home, but stay safe and yeah, catch you soon.